Many of us dream of owning a home, and for most, that dream becomes a reality with the help of home loan. However, it's important to be aware that not all salespeople have your best interests at heart. Also, while selecting the lender, home loan borrowers mostly focus on single aspect, that is interest rate, and forget to consider the rest of the things. Such mistakes can cost you dearly. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In today's video, we'll discuss about certain things which every home loan borrower should be mindful of while availing a home loan to avoid being fooled by the home loan providers. When you go to buy a home loan, most likely a home loan agent or the bank representative will push you a life and home insurance bundled with home loan. Well, you have to buy both these insurances. Like buying a home loan insurance works as a cover in case any damage is caused to the house due to some accident like fire or natural calamity such as flood, earthquake, etc. And life insurance, as it provides a safety net to the home loan company in case anything happens to you, they can recover the cost from the life insurance company. So although you need to and should buy these two insurances, but not necessarily from your home loan lender. Lenders typically bundle the insurance with the home loan, and this increases the cost. Generally, the agents of the lender will try to sell a one-time payment life insurance to you. These are generally known as home loan protection plans. To sweeten the deal, they offer to add the single premium amount to the loan. So in a way, the borrower does not have to pay anything upfront and still get the loan insured. As a result, your equated monthly installment or your EMI amount increases a bit. Let's understand with an example. So suppose if someone wants to cover 50 lakh loan for 30 years and looks to buy a term insurance plan. On an average, the annual premium for a 50 lakh for 30 years is 7,170. And you will be paying 2,15,100 over 30 years. Now instead, the single premium comes at 1,20,000 for a cover of 30 years. Now if this amount of 1,20,000 is added to your loan figure of 50 lakh, that is increasing the loan to 51,20,000, your EMI will increase from 39,335 to 40,279 for a 30-year loan at the rate of interest of 8.75%. Now, although the difference in monthly installment is quite small, but you will be paying over 2 lakh rupees extra for the same insurance that is available for 1,20,000. Let's see how. The monthly increase in EMI will be 40,279 minus 39,335. That is 944 rupees. Now, this 944 for 12 months, that 1 year will be 944 into 12, which comes out to be 11,328. And for 30 years, it will be 3,39,840. So the cost of insurance was 1,20,000, but you paid 3,39,840. That is 2,19,840 extra. So always do the math. Remember, it's not mandatory to purchase home loan protection plans. Neither the law nor the regulatory bodies such as RBI or IRDAI have made the purchase of a home loan protection plan with a loan mandatory. You can buy the cover from any life insurance company, not necessarily from the one recommended by the lender. Now, if you have a home loan running or have inquired about home loan, you will start getting calls from agents of different lenders telling you that they'll be offering the lowest interest rate in the market. While generally banks offer lower interest rates, but at times NBFCs offer lower rates to attract new customers. But here, you need to understand that NBFCs like Bajaj Housing Finance, LIC Housing Finance, etc. have higher cost of funds compared to banks. Therefore, it is unlikely that they will offer lower interest rates than what a bank can give you for the tenure of the loan. They may offer lower interest rates initially just to attract borrowers, but will most likely increase it soon after you avail a loan from them. Plus, the banks are likely to be more transparent in increasing the home loan interest rates, as most of them follow external benchmarks as fixed by the regulator to calculate interest rates. In October 2019, the RBI mandated banks to link their lending rates to external benchmarks. Most banks selected repo rate as their benchmark. So now banks calculate the interest rate as the repo rate plus spread. The spread on a home loan is determined by the loan amount and the borrower's risk group. Higher the risk means higher markup. So if the repo rate is 5, then a markup of 3.5%, the interest rate for the borrower will be 5 plus 3.5, that comes out to be 8.5%. So if repo rate goes up by 50 basis points, the interest rate will go by exactly 50 basis points. But it is not the same in case of NBFCs. NBFCs still follow the prime lending rate method of calculating interest rate on home loans. They can increase the interest rate for more than the increase in repo rate. Plus, in the case of banks, your home loan rate will automatically come down with a cut in repo rate. While in case of NBFCs, the rate of interest reduction may not happen automatically. You'll have to apply for it and may have to pay a fees every time you opt for a lower interest rate. Therefore, choose the lender wisely. And an important tip here, if you have a home loan running, do not opt for balance transfer without doing your math. If you have a home loan running, you may get calls from agents to transfer it to a different bank or NBFC offering a lower rate. But as we explained in the previous point, it may not always make sense to go for institutions offering lower interest rates always, especially in case of NBFCs for reasons explained earlier. Plus, shifting loans to lower interest rate provided by an NBFC may not save cost for you. In fact, as a rule of thumb, you should look at shifting the home loan if the remaining tenure is above 15 years and you are getting a loan cheaper by 25 basis points than what your existing lender is offering. 1 basis point is 1/100th of a percentage point. Now, those with a remaining tenure between 10 and 15 years should look at switching only if the interest rate difference is above 50 basis points. If an individual has less than 10 years remaining for the loan, then the borrower needs to estimate if there will be any savings on switching or not. Now here, consider someone who has an outstanding home loan of 50 lakh rupees at an interest rate of 7.5% and the remaining tenure as 15 years. The borrower would end up paying 33.43 lakh as interest. If another lender offers interest rate of 7%, the interest rate payment for the loan tenure will fall to 30.89 lakh. The borrower will end up saving 2.54 lakh or would be able to reduce the tenure by around 10 months. Therefore, don't get fooled by the agents, do your math. And this brings us to the end of this video. Don't forget to share it with someone you know who is looking to buy a house or has already availed a home loan. Let's together save our friends and family from falling for financial traps.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.